With the RBA flagging the possibility of more interest rate rises, I've had a lot of clients reach out to me over the last couple of weeks asking one thing: should I stay variable or should I explore fixed rates? There's no one size fits all, so today I want to break down the difference between variable and fixed rates, show you the current rates on the market so you can make an educated decision on what suits your individual situation.
First, let me give you a quick snapshot of where rates sit right now. Variable rates for owner-occupiers are currently around 5.6%. Fixed rates for 2 years are sitting at around 5.7% from reputable lenders. So fixed is already slightly higher than variable at the moment. But that gap matters a lot less than most people think, and I'll explain why in a second. So what is a variable rate, and what are you actually getting? A variable rate moves with the market. When the RBA generally raises the cash rate, lenders will generally pass some or all of that through, which means your repayment goes up. It doesn't necessarily go up straight away. Generally there is a 1 to 2 month lag. When the RBA cuts, on the other hand, the opposite can happen. Right now, with rate rises on the table, that's the key risk with staying variable. You could be sitting at 5.6% today and find yourself at a higher rate in 6 or 12 months if the RBA moves. The upside of variable is flexibility. You can make extra repayments without penalty. You can use an offset account. And you can refinance without a break cost if you find a better deal elsewhere. For people who want to aggressively pay down their loan, or who have a lot sitting in their offset account, variable can still make a lot of sense even in a rising environment. Now let's talk about fixed. Fixing your rate means you lock in a set interest rate for a period of time. In this case, let's say 2 years at around 5.7%. Your repayment doesn't change. It doesn't matter what the RBA does during that period. You're locked in. If rates rise, you're protected. If rates fall though, you won't benefit. But you had certainty. And for a lot of people, that's genuinely valuable. The trade-off is flexibility. Most fixed rate loans restrict how much extra you can repay, often capped at around $10,000 per year above your minimum repayment. Offset accounts are usually not available on fixed rate loans or are very limited. And if your circumstances change, i.e. you need to sell, refinance or pay the loan out early, you could be hit with a break cost, which in some cases may be significant. So now the question, which one is right for you? Now before I get into that, one important thing worth keeping in mind is that fixed rates are generally available for periods from 1 to 5 years, and a lot can change in that time. Cast your mind back to mid last year. The conversation everywhere was about rate cuts coming. Fast forward to today, and we're talking about potential rate rises. That's a pretty significant shift in a short period of time. And it's a good reminder that when you fix, you're making a decision based on where things are right now, not where they'll be in 12 to 24 months' time. Nobody knows for certain where rates are heading. So fixing isn't about predicting the future. It's about deciding how much uncertainty you're comfortable living with. Here's how I like to think about it. Fixed rates make a lot of sense if payment certainty matters to you. If your budget is tight, if you're a single income household, or if you just want to know exactly what's coming out of your account each month for the next couple of years. It also makes sense if you don't have a lot sitting in an offset account and you're not planning to make large extra repayments. Variable makes more sense if you have a healthy offset account balance and you're aggressively paying down your loan. Or if you think your circumstances might change and you need that flexibility to refinance or sell without penalty. One thing worth mentioning is resetting your loan term as well. When people refinance, they sometimes have the option to extend their loan term back to 30 years. This is sometimes referred to as debt recycling. On the surface, it looks attractive because it lowers your monthly repayment. And if rates rise, that breathing room can feel appealing. But it's important to understand the trade-off. If you've already been paying your loan down for 5 to 10 years and you reset the clock back to 30 years, you're extending the life of your debt and paying a lot more interest in the long run. Personally, I'm a fan of it in the right circumstances though. If that freed up cash is going to be put to work, whether that be making accelerated repayments on your mortgage or building your wealth in another way, it's smart. Where I'd pump the brakes is if that extra money each month is going to disappear into everyday spending. Resetting your term to fund lifestyle costs isn't a strategy. It's just more debt for longer. So just like most things in finance, it comes down to what you're actually going to do with it. And there's a third option that doesn't get talked about enough, and that is splitting your loan. You can fix part of your loan and keep a part variable. So you might fix 60% to lock in some certainty and keep 40% variable, so you can still use your offset account and make extra repayments on that portion. It's a way of hedging. You're not fully exposed to rate rises, but you're not completely locked in either. It's a really common structure and worth considering if you're torn between the two. So the practical takeaway is I want you to ask yourself 3 things. How important is payment certainty to me right now? Do I have a meaningful offset account balance? And how likely am I to need flexibility in the next 2 years? Your answer to those 3 questions will tell you more than any rate comparison chart will. Now, everyone's situation is genuinely different, and the right structure for your neighbour might be completely wrong for you. If you want to talk through what makes sense for your loan, feel free to reach out. That's exactly what we're here for.